Good morning, everyone. Welcome to Almus Market Mornings, your daily dose of financial updates. I'm your host, Swaraj, and with me, I have our market expert, JK. Now, it's a pleasant morning here in Mumbai, but it's not been very pleasant for tech stocks, which had a bad day yesterday. Nasdaq tumbling nearly 2.2%. In fact, this month has been bleak for Nasdaq as we had zero stocks hitting 52-week high in the index. While in the currency market, we continue to see recovery in euro as we had seen some correction in the dollar index. JK, good morning. What can you tell us about the sell-off in tech stocks, and please take us through the other developments?
Good morning, Swaraj. Worries about higher financing cost and fears that economy can slip into a recession came back yesterday to haunt investors, pushing the major indices in the US to negative territory. However, a later recovery was seen, barring Nasdaq, which ended more than 2% lower. The economic data also added to fears when flash manufacturing PMI showed decline from 57 to 57.5 from 59.2. Services component actually slipped a lot, and the composite index was also down. Apart from that, we have also seen the US new home sales plummeted in April by almost nearly by the most in nearly 9 years, dented by a combination of high prices and a steep climb in mortgage rates. So that's the deadly combination: rates increasing and economy is slowing down. But some relief for the investors when one of the Fed members, Bostic, said that Fed may have to pause after 2 rate hikes in June and July, and we need to move a bit cautiously. That's a statement which actually brought down the yields. The 30-year also is now trading below 3%. Now, coming more specifically to the question of Nasdaq, while everything looks bad, it's no single new high made for any of the Nasdaq stocks and all that. I think technically picture is looking ripe for a good recovery in Nasdaq stocks. We are at very strong technical support zone of 200-week moving averages, and I can see positive divergences in the daily charts, and also they look oversold. So I think it's just one strong trigger for Nasdaq to rally by even 8 to 10% from these levels. Can't see from these levels, even if it has to lose more, it cannot lose from these levels. Let's move to the other side of the Atlantic. Data from Europe was quite good, and Eurozone economy, in fact, has been showing better numbers of late. The German IFO numbers came much better than expected. All the 3 components, the conditions, current conditions, and also the future outlook, they all came better. Even among the PMIs, German manufacturing was slightly slower, but the services component was very strong, overall pushing the PMI into positive territory. So that's one thing. Also, Lagarde continues to now suddenly talk about European Central Bank at a turning point, about to hike rate, and that's also stemming from the fact that the Eurozone economy is not doing as badly as the investors had discounted. But quite the other side for the UK, where the services PMI came very poor, and again, the fear is that UK is going to slip into a stagflationary situation because the inflation is at a multi-decade high, and economic data has been very, very mixed. And yesterday's number was very worrisome for the investors. You also have from the Asian side, the New Zealand Central Bank, which has hiked the rate by 0.5%. And that's second consecutive hike of 0.5% hike by the central bank. It is a decision that is backed by the fact that inflation is running at 6.9%, the fastest pace in more than 30 years. So stocks, I feel, are due for another bout of recovery, particularly the Nasdaq. I am more bullish from these levels for a recovery of 8 to 10%. On the currency front, we have been seeing several central banks like Bank of England, Canada, and even Australian Central Bank raising rates. And today also there is an indication from one of the Australian Central Bank member that more rate hikes will be on the card. But all this has been ignored by the market and mostly looking at what is Fed doing and how much they hike. But that scene seems to be slowly taking a huge turn. Market is starting to think Fed rate hike will not go too far, and whereas the dollar price has discounted a bit, but the rate hikes by other central banks, particularly the ECB now indicating even maybe a 0.5% hike in July. This is impacting the dollar, bringing it down by more than 3%. Euro has also risen by more than 3%. We have seen Chinese yuan recovering by 3%. So on the currency front, we are seeing a good change. The one-sided move of the dollar has got reversed. Whether it's a change of trend, it's too early to say. But I think the correction, even if you assume it is, a short-term correction, it still has some legs to go. On the rupee front, of course, the same factors are at play, and we do not have an indication to show that we are moving into any sort of directional move. We are restricted on both sides by the well-known factors, RBI on one side and oil and FI buyers on the other side. We have been reacting very mutedly to moves in the dollar index. So doesn't inspire much to the traders. But yes, for corporates, it's not a complaining situation because it's a stable market. How much stability will continue is purely dependent upon the RBI's policy of selling because the demand side is still overpowering. Technically, we have many layers of support for the USD/INR from 77.50 up to 76.90, and hence any corrective moves will be very labored and it will be very shallow. Thank you.
Okay, thank you, JK. And as JK was mentioning, data from Europe, we saw German PMI coming in better, backed by better services, while there has been some rate hikes in New Zealand. Now the world is entering into a rather different phase as compared to what we have seen in the recent years. Situation of inflation, tightening monetary conditions. So a good risk management policy helps to mitigate such uncertainties. That's it from our end. We'll see you all tomorrow with the latest developments. Thank you.